Hello and welcome back to Boni's Life, your home for navigating the exciting and sometimes a little crazy world of crypto. If you're feeling a bit down about the sea of red in your portfolio lately, you're not alone. The bears are out to play, and it can feel like they're having a feast at our expense. But what if I told you that a bear market isn't just a time for hibernation? What if it's actually a golden opportunity to build a stronger, more resilient portfolio for the next bull run? Now, I know what you're thinking. Boni, have you been sniffing too much of that hopium again? And to that I say, maybe just a little. But in all seriousness, today we're going to dive deep into the strategies that can help you not just survive but thrive in these bearish times. We'll be looking at everything from active trading strategies like range trading to more passive income opportunities like yield farming and liquidity provision. We'll break down the pros and cons of each, and I'll give you my take on what might work best for you, whether you're a seasoned trader or just starting your crypto journey. So grab your notebooks and let's get ready to turn this bear market into our bulwark of opportunity. Before we get into the nitty-gritty of trading strategies, let's take a quick look at the current state of the market. As of today, February 4th, 2026, the global crypto market cap is sitting at around $2.64 trillion. Now, that might sound like a huge number, but it represents a nearly 3% drop in the last 24 hours. Bitcoin, our beloved king of crypto, is trading at around $75,700, down over 15% in the last week. Ethereum is also feeling the pain, down over 26% in the same period, trading at roughly $2,230. Solana has taken a significant hit as well, dropping 25% over the past 7 days to trade at approximately $95. Let me share some more sobering numbers from CoinGlass. The total open interest in the derivatives market stands at $107.7 billion, down about 1.3% from yesterday. But here's the kicker. 24-hour liquidations have surged by a staggering 128% to $701 million. That's over $700 million worth of positions wiped out in a single day. The long/short ratio is sitting at 48.74% longs versus 51.26% shorts, which tells us that traders are slightly more bearish than bullish right now. And the Fear and Greed Index, a great little tool for gauging market sentiment, is currently at a bone-chilling 13, which is firmly in the extreme fear category. So yes, the bears are definitely in control right now. But here's the thing about bear markets. They don't last forever. And more importantly, they present unique opportunities. While the fair weather tourists have packed their bags and gone home, the serious builders and investors are quietly accumulating and positioning themselves for the future. This is the time to be greedy when others are fearful, as the old saying goes. But being greedy doesn't mean being reckless. It means being smart, strategic, and informed. So let's start by looking at a popular strategy for active traders in a sideways or bearish market, range trading. So what exactly is range trading? Imagine a ping pong match. The price of an asset is the ball, and it's bouncing between two distinct levels, a support level on the bottom and a resistance level on the top. A range trader is like a player who buys the ball every time it hits the support level and sells it every time it hits the resistance level. It's a strategy that thrives in markets that aren't trending strongly up or down, but are instead consolidating within a specific price range. And in a bear market, you often see these periods of consolidation where the price takes a breather before its next big move. Now, the beauty of range trading is its simplicity. You don't need to be a wizard with complex technical indicators, although they can certainly help. The core of the strategy is identifying those support and resistance levels. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Think of it as a floor that the price keeps bouncing off of. Resistance is the opposite. It's a price level where an uptrend can be expected to pause temporarily due to a concentration of supply. It's like a ceiling that the price keeps hitting its head on. You can identify these levels by looking at historical price charts. Look for areas where the price has repeatedly bounced off of. The more times the price has tested a level and reversed, the stronger that level is considered to be. Once you've identified your range, the strategy is straightforward. You buy at support and sell at resistance. For example, If Bitcoin is trading in a range between $70,000 and $80,000, a range trader would look to buy when the price approaches $70,000 and sell when it approaches $80,000. The profit is the difference between your buy and sell price minus any trading fees. It's a great way to generate consistent, albeit smaller, profits while the market is figuring out its next direction. But, and this is a big but, range trading is not without its risks. The biggest risk is a breakout. A breakout is when the price breaks through the support or resistance level and starts a new trend. If you've bought at support and the price breaks down, you could be looking at significant losses. That's why it's crucial to use stop-loss orders. A stop-loss order is an order you place with an exchange to sell an asset when it reaches a certain price. It's your safety net. For example, if you buy Bitcoin at $70,500, you might set a stop-loss at $69,500. If the price drops to that level, your Bitcoin will be automatically sold, limiting your losses to just $1,000 per Bitcoin rather than potentially much more. Another tool that can help you with range trading is a grid trading bot. A grid trading bot is an automated tool that places a series of buy and sell orders at predefined intervals within a price range. It's like having a little robot that does the range trading for you 24/7. This can be a great option for those who don't have the time to constantly monitor the charts. However, just like manual range trading, grid bots are also vulnerable to breakouts. So if you decide to use one, make sure you understand how it works and how to set it up properly. Many exchanges like Binance, KuCoin, and Bybit offer built-in grid trading bots that you can configure with just a few clicks. Now, let's shift gears and talk about some more passive strategies for a bear market. If you're not a fan of the stress and constant chart watching that comes with active trading, then yield farming and liquidity provision might be more your speed. These are strategies that allow you to put your crypto to work and earn a passive income, kind of like earning interest in a traditional savings account, but with potentially much higher returns. Yield farming, in a nutshell, is the practice of lending or staking your cryptocurrency in exchange for rewards. These rewards can come in the form of interest, new tokens, or a share of the platform's fees. There are many different ways to yield farm, but one of the most common is through decentralized exchanges, or DEXs. DEXs are platforms that allow you to trade cryptocurrencies without the need for a central intermediary, like a bank or a traditional exchange. Popular DEXs include Uniswap, SushiSwap, PancakeSwap, and Curve Finance. To facilitate these trades, DEXs use something called liquidity pools. A liquidity pool is a smart contract that holds a pair of tokens, for example, ETH and USDC. Users, who are called liquidity providers, can deposit their tokens into these pools. In return for providing liquidity, they receive a share of the trading fees that are generated every time someone trades using that pool. This is the essence of liquidity provision. The more liquidity you provide, the larger your share of the fees. Now, the returns from yield farming and liquidity provision can be very attractive, especially in a bear market. While the price of your assets might be going down, you can still be earning a steady stream of income from your holdings. For example, on some platforms, you can find ETH USDC pools that are offering an APY, or annual percentage yield, of around 35%. Stablecoin pools, which are pools that consist of two stablecoins like USDC and USDT, can offer APYs in the range of 3 to 15%. Platforms like Pendle and Haven One have been offering consistent returns of 10 to 15% APY on stablecoin strategies. These are returns that you're simply not going to find in the traditional financial world, where savings accounts might offer you 1 to 2% if you're lucky. And you knew there was a but coming, these higher returns come with higher risks. The biggest risk associated with liquidity provision is something called impermanent loss. Now, impermanent loss is a bit of a misnomer because if you're not careful, it can become very permanent. Impermanent loss happens when the price of the tokens in a liquidity pool changes relative to each other. Let's go back to our ETH/USDC pool. If the price of ETH goes up significantly, the pool's automated market maker, or AMM, will sell some of the ETH for USDC to maintain a 50-50 balance. This means that as a liquidity provider, you'll end up with more USDC and less ETH than you started with. If you then withdraw your liquidity, you might find that the value of your holdings is less than if you had just held onto your original ETH and USDC. That difference is impermanent loss. Let me give you a concrete example. Say you deposit 1 ETH and $2,000 USDC into a pool when ETH is worth $2,000. Your total deposit is worth $4,000. Now, let's say ETH doubles in price to $4,000. If you had just held your original tokens, you'd have 1 ETH worth $4,000 plus $2,000 USDC, totaling $6,000. But because of how the AMM works, your pool position might only be worth around $5,657. That's an impermanent loss of about $343, or roughly 5.7%. The trading fees you earned might offset this loss, but it's something you need to be aware of. So, how do you mitigate impermanent loss? One way is to provide a liquidity to pools with assets that have a high correlation, meaning their prices tend to move together. Stablecoin pools are a great example of this. Since both tokens are pegged to the US dollar, their prices are relatively stable, which minimizes the risk of impermanent loss. Another strategy is to look for platforms that offer impermanent loss protection. This is a feature that some platforms offer to compensate liquidity providers for any impermanent loss they might incur. Bancor, for example, has offered this feature in the past. There's also another risk we need to talk about: smart contract risk. When you deposit your funds into a DeFi protocol, you're trusting that the smart contract code is secure and bug-free. Unfortunately, that's not always the case. There have been numerous hacks and exploits in the DeFi space where millions of dollars have been stolen due to vulnerabilities in smart contracts. This is why it's important to only use well-established audited protocols and to never invest more than you can afford to lose. Now, let's compare these strategies head-to-head. Range trading is an active strategy that requires you to be constantly monitoring the market. It can be very profitable in a sideways market, but it's also very risky. You need to have a solid understanding of technical analysis, you need to be disciplined with your stop losses, and you need to be prepared for the possibility of breakouts. Yield farming and liquidity provision, on the other hand, are more passive strategies. They allow you to earn a steady stream of income from your crypto holdings, but they also come with their own set of risks like impermanent loss and smart contract risk. So, what's the best strategy for you? Well, it really depends on your risk tolerance, your time commitment, and your overall investment goals. If you're an active trader who is comfortable with risk and has the time to monitor the charts, then range trading could be a great option for you. But if you're a more passive investor who is looking for a way to earn a steady income from your crypto holdings, then yield farming and liquidity provision might be a better fit. Now, let's talk about what to do if you're an active trader in this market. First and foremost, you need to have a plan. Don't just jump into trades based on a gut feeling or a tip from a friend. Do your own research, identify your entry and exit points, and stick to your plan. Second, you need to manage your risk. Use stop-loss orders to protect yourself from big losses. And don't risk more than you can afford to lose on any single trade. A good rule of thumb is to never risk more than 1 to 2% of your total portfolio on a single trade. Third, you need to be patient. The market is not going to turn around overnight. There will be ups and downs, and it's important to stay calm and not let your emotions get the best of you. Fear and greed are the two biggest enemies of a trader, and in a bear market, fear can be particularly overwhelming. If you're a passive investor, your approach will be a little different. Your main focus should be on accumulating quality assets at a discount. Dollar cost averaging, or DCA, is a great strategy for this. DCA is the practice of investing a fixed amount of money into an asset on a regular basis, regardless of the price. For example, you might decide to invest $100 into Bitcoin every week. When the price is high, you'll buy less Bitcoin, and when the price is low, you'll buy more. Over time, this strategy can help you lower your average purchase price and build a solid position in the market. Studies have shown that DCA can reduce portfolio volatility by up to 40% compared to lump sum investing. Another thing to consider as a passive investor is staking. Staking is the process of locking up your cryptocurrency to help secure a blockchain network. In return for staking your coins, you receive rewards similar to how you would earn interest in a savings account. Staking is generally considered to be less risky than yield farming because you're not exposed to impermanent loss. However, the returns from staking are also typically lower than the returns from yield farming. For Ethereum, for example, staking rewards are currently around 3 to 4% APY, which is lower than what you might get from a high-yield liquidity pool, but it's also much safer. Let me also mention a few other strategies that can be useful in a bear market. One is short selling, which is betting that the price of an asset will go down. This can be done through futures contracts or margin trading. However, short selling is very risky, especially in crypto where prices can be extremely volatile. A sudden price spike can lead to massive losses. So this strategy is only recommended for experienced traders who understand the risks involved. Another strategy is to focus on accumulating blue-chip cryptocurrencies. Bitcoin and Ethereum are considered the blue chips of the crypto world. They have the strongest fundamentals, the largest market caps, and the most institutional support. While they're not immune to bear markets, they tend to recover faster and more reliably than smaller altcoins. So if you're going to be accumulating during a bear market, it makes sense to focus on these established assets. So to recap, a bear market is not a time to panic. It's a time to be smart, strategic, and informed. Whether you're an active trader or a passive investor, there are strategies that you can use to not just survive but thrive in these challenging times. For active traders, range trading can be a great way to generate consistent profits in a sideways market, but you need to be disciplined with your risk management. For passive investors, yield farming, liquidity provision, and staking can be great ways to earn a steady income from your crypto holdings. But you need to be aware of the risks like impermanent loss and smart contract vulnerabilities. And for everyone, dollar cost averaging into quality assets is a time-tested strategy that can help you build wealth over the long term. Remember, the crypto market is cyclical. Bear markets are followed by bull markets, and bull markets are followed by bear markets. The key is to use the bear market as an opportunity to position yourself for the next bull run. The people who are buying now when everyone else is fearful are the ones who will be celebrating when the market turns around. And that's all the time we have for today, folks. I hope you found this information helpful. If you did, please be sure to hit that like button and subscribe to the channel for more content like this. Drop a comment below and let me know which strategy you're using in this bear market. I'd love to hear from you. And as always, remember that this is not financial advice. Please do your own research before making any investment decisions. The crypto market is highly volatile and you should only invest what you can afford to lose. Until next time, stay safe, stay informed, and I'll see you in the next video.